Silicon Valley Bank just failed. This is the second largest bank failure in US history and the largest bank failure since, get this, 2008. Will contagion spread across the entire financial system? Let's dig in.
Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
Wednesday, Silvergate announced it's ceasing operations. Thursday, Silicon Valley Bank stock crashes 60% as the bank scrambles to shore up liquidity. Friday, Silicon Valley Bank fails. It's taken over by FDIC. But get this, only 2.7% of Silicon Valley Bank's deposits are less than $250,000, meaning 97.3% aren't even FDIC insured. So those customers will likely lose this money. It's been a horrible week for banks. Silicon Valley Bank tried to raise capital and they couldn't. Then they tried to sell themselves to a larger bank and then they couldn't. And so that's when FDIC stepped in and they're going to attempt to salvage customer assets, although not looking very good. Is this the tip of the iceberg? And how intertwined are all of these banks? Many banks are facing the same problem. Their bond portfolios were locked in at low rates. As depositors withdraw money, banks have to sell their bonds at huge losses to come up with the money. If too many customers withdraw at once, the bank losses could be massive. Silicon Valley Bank's problem started with a $1.8 billion loss on the sale of its available for sale bond portfolio. Rumors swirled that Silicon Valley Bank was facing huge interest rate risks on its $91 billion portfolio. And this panic caused some customers to withdraw money. It's unclear how much at this point, but this is what started it all. Withdrawals feed the vicious cycle of selling bonds at a loss to cover the outgoing deposits. Silver Valley Bank theoretically had the assets to cover deposits, which they are legally obliged to do. But the real question was, how liquid are those assets? And can they be liquidated without causing massive losses? Turns out the answer to that last question is no. Are other banks facing this problem? Absolutely. Take First Republic Bank. Its stock was down as much as 50% today on similar fears, but has since recovered a bit. But the word contagion doesn't necessarily apply to the issues with bond portfolios. This issue has little to do with its relationship with other banks. It would be a problem regardless of Silicon Valley Bank's dealings with other banks. Interest rate risk is an inherent challenge of running a bank. However, a contagion could still be playing out. Now, many are comparing this to 2008 with Lehman Brothers and Bear Stearns. Now, one thing to keep in mind, those were investment banks that were leveraged at the peak about 31 times. These are commercial banks that we're talking about today. Very under leveraged compared to those, so very different risk profile. Hit that follow button if you don't want to miss more insights like